Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns and Seeking Alpha. Today, I want to talk about Stitch Fix. Stitch Fix curates customers' apparel. There is an overabundance of choice out there for customers, and being able to offer something personalized removes a lot of the stress, and it's really time consuming to often to choose outfits. You see, I always choose the same thing, so I totally get that. The idea being that its algorithm is able to tailor to a person's particular need. Okay, that's the narrative. The problem is that it's been struggling to ignite its growth rates, and even though the stock looks really cheap at approximately one times forward sales, it's I don't think it's really that cheap. So I'm gonna get right into this if you don't mind. So I mean, the past 6 months the stock has been like it's a reasonably highly shorted stock. It's just been like absolutely battered. It's down approximately 57% in the past 6 months, and it's down after hours approximately 18%. So, I mean, yeah, I get this. A lot of people will be frustrated with this one. Also, bear in mind that it's December, so that means tax losses, people. So, I mean, it's difficult for investors. Um, right now, this is the modus operandi. People are going to be selling first, asking questions later, irrespective of valuation. Valuation is not going to matter now. It's just it's going to get difficult for investors. Just briefly remember that the fiscal year and the calendar year here are misaligned. So I'm going to be talking about this fiscal year, and it gets a bit confusing because they're talking about fiscal 22, which ends in July. So just bear with me. I'm talking about the fiscal year, okay? Um, so back in September last year, they were guiding to be approximately up 15% for this fiscal 22. Okay. Now keep in mind that last night they actually downwards revised their guidance to be up 9% for the year. Now, on the backdrop of this, remember Peloton, Teladoc, Roku, DocuSign. What do those names have in common? Those names are stocks that everyone saw as COVID winners, and then they gave back a lot of those gains. So on that backdrop, everyone's thinking, okay, Stitch Fix is the same. It's a COVID winner, and people are just going to dump this. I mean, it's it's a difficult one. I mean, I get the narrative, but when the stock is like down substantially and there's a lot of shorts in this name, I mean, it's really difficult to meaningfully get behind this investment. Now, keep another thing in mind, right? So Stitch Fix has two operations. It has what it calls a fix, which is it uses algorithm to personalize apparel and shoes and accessories for individuals. And then it has this other thing which is called freestyle. Freestyle is essentially a person going on a website and choosing an outfit that suits them. Now, how is that different from any other kind of e-commerce apparel clothing company? I don't really know, and that's the problem, right? So that side of the equation, the freestyle side of the equation, was up 40% year over year. Now, if you think about it, that means that the fixed side, where it uses algorithm to kind of offer a personalized outfit, hasn't done that well during the quarter. And this is the core business model. So if the core business model isn't doing so well, this kind of brings up questions for investors as well. Now, one more thing that I want to highlight. During Q1 2022, which is the quarter just reported, new clients were up, active clients were up 11% year over year. Now remember, if we go back 6 months, we go back to May 21, active clients were up 20% year over year. Then for the quarter end in July, which is Q4 21, they were up 18%. So it was up 20%, up 18%, and now up 11%. So if you're not getting a lot of customers, it's kind of for a high growth name, or sorry, for a growing company, it's gonna be difficult. Now, keep in mind another thing. During the call, they talked about the privacy changes, IDFA, and how that has impacted the onboarding of new customers. So with that in mind, they're gonna try and change how they approach new customers, look towards new channels, and they're going to try in the next several months to come out with a more rounded solution for this. But that's still something that's going to be overhanging at least in the near term. Now, cash flow here remains an issue, right? So if you remember last quarter, they talked about EBITDA margins for fiscal 22 to be north of 2%. Okay, this was a slight drop from the 3% in fiscal 21. So it kind of like investors are kind of, it doesn't look that great. So they weren't able to see a proportional growth towards the bottom line. So they were suspected to grow on the top line, but they weren't seeing a proportional growth. The EBITDA margin was supposed to come was 3% for fiscal 21, and then north of 2% for fiscal 22. And now they downwards revised the guidance slightly here, so it's going between 1 and 2%. So that probably at the midpoint comes in at 1.5%. So there's a contraction there. Now keep in mind that when they had EBITDA margins of 3%, they actually reported negative 51 million of free cash flow. So if you have even smaller EBITDA margins, what will that happen? What will that translate to in terms of free cash flow? So it's a question. I don't really know the answer to that. So on the surface, the stock looks cheap. You're paying approximately 1 times forward sales. Think about that, right? That's not very expensive. That being said, you don't have very attractive free cash flow margins. I mean, and the EBITDA margin that they're guiding for is like it's just razor paper thin. Investors are quite happy to incur meaningful losses in terms of free cash flow, provided that they see a strong growth rate. And you're not seeing a strong growth rate, but you are seeing the unappetizing EBITDA margins. On a positive note, the company has no debt on its balance sheet, and it has 400 million worth of cash. That implies that they can continue doing this and for some time without having to resort to financial markets for more capital. So that's positive, right? Now, here's a few things that I want to highlight. So, I'm a value investor, so I totally get the situation. I've been in this situation before, and I'll get in this situation again, and that's how it is, right? The professional investor understands that's how it goes, right? That's how I described it to you. It's just part of the game. The amateur gets really frustrated and kind of like, oh God, what's going to happen? And the amateur is hoping to return to break even before realizing what to do. Okay. Now, here's two things I wanted to highlight to you. First, nobody knows the price that you paid for the stock. So nobody knows what price to return to. The stock will go towards its fair value. End of story. It doesn't go towards what you paid. Nobody knows. Secondly, it's just that's how it is, right? So you're gonna have some winners, you're gonna have some losers. This is a loser, fine, so be it. So yeah, if you want to find out what kind of names I'm excited about right now, don't forget to check out my marketplace. It says right there, deep value returns. So check out what stocks I'm kind of getting involved with, and don't forget to hit me up there and just see how it goes.